My name's Kevin Martin. I'm here with the Lake Erie Regional Grape Program, and this is our weekly podcast update. Thanks for joining me today. I wanted to talk a little bit about some redirection. So it is December. We actually have had some growers report to me that they think maybe they made some money this year, which is not something I've heard at least a concern about in the last 5 years. So I think most growers know what that means. If you actually make more than a little bit, the last thing you want to do is pay it out in taxes. That's a great problem in my perspective to have. I actually really enjoy paying taxes because it means I made money. But I do understand that farm income is very volatile, so the tax rates that you pay do bounce up and down, and you'd prefer to have that leveled out. So the obvious strategy is to go buy a fancy new tractor. And I had a grower talk to me about concerns about making payments and new paint syndrome and how to strategically invest in capital and what they should be buying to avoid paying Uncle Sam. So I'm actually going to redirect here. We've talked a little bit about capital investment on previous podcasts and where you should be spending your money. But what can you do to avoid taxes besides spending your money? One of the easiest things to do is to keep it. To avoid taxes, you're going to have to hide it. And the way you hide it is commit it to retirement. So for doing the socially responsible thing of taking care of yourself when you're 70 or 75, you get a tax break. There are some restrictions. It's a little bit different for the self-employed population. A lot of it's good. Some of it's not. For those of us that have a large employer, they typically provide a 401k or something similar, and they might help you out with that. They might not, but usually it's there for you to use if you want to use it. The issue with a 401k is there's a lot of paperwork. There's hundreds and hundreds of pages of paperwork. The last thing that they want to happen is that different classes of employees are treated differently. There's a lot of issues with it, so it ends up costing per employee quite a bit of money if you don't have very many employees. So it is an option to get a 401k, but it's going to cost you $10,000 a year to get it. If you have 1,000 employees, that's not a big deal. If you have 3, it's a problem. So we have these other vehicles. We have an individual 401k. It's a simplified plan. You don't get to customize it. Cuts down on the paperwork, substantially reduces the cost. We have a simple IRA or a simple IRA. Instead of a regular IRA, it's more simple. Again, they are limiting the flexibility you have in the plan, and in exchange for that, they don't have as much paperwork, and you can actually afford to do the plan with a small number of employees. And a SEP IRA. A SEP stands for a simplified employee pension. The IRA on the end is important to note. This means it's that it's a retirement account that is not a traditional pension. It is not a defined benefit. You don't really want to get into that. This is a defined contribution. You decide what you want to put in there, and you put it in there. You don't have to worry about promising anything and paying later. So again, kind of like a 401k. So which one do you want? There's 3 choices, and there may be more. These are the 3 that are popular right now. There's a Key Hog IRA as well. I'm not going to talk about that today. So the biggest variability is your employee situation. So if you have employees, we can kick the individual 401k right out. The way they made that simple enough so you could afford it is you're not allowed to have any employees. If you have employees, you're going to get pushed into a regular 401k, so forget about it. The nice thing about a 401k, the individual, is how it works. So if you have a business entity that generates an income for you, particularly earned income, and it doesn't have employees, because I know a lot of growers divide their assets and revenue into multiple entities. You do want to take advantage, I think, of the individual 401k. These are all great options, but if you don't have any employees, it's probably the one that works best for you. One of the reasons for that is the flexibility with the contribution limits. So as an individual, so one of the things you really need to understand about all these plans is that for you personally, you are both the employer and the employee. So you can make contributions to yourself in your own account as an employer, and you can make them as an employee. So you're making them on both sides of the aisle. Whereas for me, if I work for somebody, my employer makes contributions and I make contributions. They're separate because we're separate entities. I don't feel that connection like you do. So it's more of a complicated thing to understand when it might be coming from the same checking account. It doesn't matter. You have to label it as an employer contribution or employee contribution, but you can do both. And you on the employer side, you can do around $55,000 as a maximum, up to 25% of your compensation. So if you have a net revenue in this entity of a couple $100,000, you can squirrel away 55. And on the employee side, these are similar to a 401k limitation. So maybe you've heard that if you have a working spouse, $19,000, and then there's a catch-up in addition to that if you're over 50. So you're looking at 25, so for a total of almost $80,000. And so that's the benefit of that individual 401k. If you have really volatile income, you're not going to make anything next year. You're going to make a lot this year. You can save $80,000 this way, but no employees. If you do have employees, you have access to the SEP or the Simple. The other thing you need to consider is, do you actually want these employees to participate in the plan? And if you don't, you want to go with a SEP IRA. If you go with the Simple, the nice thing about the Simple is you can contribute quite a bit, but you will need to provide access to the plan for your employees, and that might be something that you can actually do. You can restrict the eligibility to the plan, because I understand that your temporary seasonal employees, you probably don't want to deal with this hassle, but it can be a valuable tool for your employees that you're trying to retain for a long period of time. Maybe you have one full-time employee, maybe it's a family member, maybe it's a niece or a nephew, and helping them out with a simple IRA is something you want to do anyway. This is a relatively simple way to do it. So on the employer side, you can do a dollar for dollar match up to 3%. So they put in $1, you put in $1. If they make $10,000 a year, it's just the 3% of the $10,000. So in a situation where you're paying someone close to minimum wage and your income bounces around like crazy, like maybe one year you make minimum wage and one year you make $100,000, the contributions on the employer side will reflect that. There's another option where you can contribute 2%. The maximum there is 2% of $275,000, and that'll go up every year. So that should be $290,000 next year, I believe. Employees can contribute as well. They're not required to do that, but again, this is a match, so this is another thing that's going to help you out. If they're not comfortable doing that match, you don't actually have to contribute, and you can lower that match from 3% to 1%. So in a lean year, you can decrease it. In 2 out of 5 years, you're able to do that, which is not something you'd ever see a normal employer do, but it's a really good tool for farmers. That would be what I would recommend doing. I would recommend giving your employees access to that. I don't think that the 3% or the 2% is too onerous, and I think it probably is going to pay dividends in terms of employee longevity. So, employees are eligible if they receive at least $5,000 from you in any 2 preceding calendar years and can reasonably expect to earn at least $5,000 in the current year. You can expand the group of eligible employees by reducing or eliminating the minimum compensation requirements, but you cannot increase the compensation requirements above and beyond that $5,000. So this is the only catch. If you did have a pruning crew that had individuals earning more than $5,000 that did want to contribute, you'd have to let them, and you would have to match it at the 3% or 2% level, or occasionally 1%. That's something you would need to decide for yourself. I would kind of lean on the idea that if I was forced to do a simple IRA because I didn't have a business without employees, and I wanted to help out a key employee, the 1% or 2% of the pruning crew's salary, and the likelihood that they actually want to participate being as low as I think it probably would be, I would go ahead and not be afraid of a simple IRA. A SEP IRA is a little bit different. You don't necessarily need to contribute on behalf of your employees. There's a one-person SEP IRA that's going to allow you to do this. Employees are eligible to do this. They can put a little bit in, the $5,500. So as an employee, you'd be capped at that $5,500. The employer contributions look much more like the individual 401k of $56,000, and that's capped at 25% of your gross, or 20% depending on the situation you're in. And I don't need to get into the details. So the SEP IRA does allow you to contribute a little bit less, but there are instances where if you have employees that you don't want to have access to your retirement plan, a SEP IRA would be the tool for you. But the nice thing about the individual 401k are the options that you have in terms of putting quite a bit more in. I think that's about all I have. If you have questions about any of these retirement plans, you can give me a call. A lot of the low-cost mutual fund providers, if you've heard about any of them, they offer all of these plans. I think it's a really great alternative rather than purchasing a tractor if you feel like you're in an income bracket that you're not accustomed to being in and you want to get out of it. I think that's about all I have for today. I know we covered a lot, and I know a topic like this is maybe not the most exciting, or not what you do on the day in and day out. You'd rather be out in the field, but I appreciate that you are joining us. I hope that this helps, and if you have questions, again, please feel free to comment below or reach out. It's been a pleasure. Thank you.